But let's welcome in our next guest. We've got Sanjiv Bhasin, Executive Vice President, Markets and Corporate Affairs with India Infoline, joining us in Delhi. Sanjiv, good to have you with us in the studios. A day earlier, the markets corrected sharply because of geopolitical reasons. And today, we didn't have the global cues very supportive. We correct when the news is bad for us, and we didn't have any footing to stand on because news is bad even internationally, notably what's happening with Deutsche Bank. Do you think now the markets are getting into a time and area where there will be further correction, or given how the markets have performed today, the correction is done?
Well, in one day you don't end such sharp corrections, Anisha, firstly. Secondly, like you said, Deutsche Bank and the European banks are under extreme stress, and we cannot wish that under the carpet. Credit costs are going to rise as is indicated in the bond yields. And thirdly, geopolitical risk is now there for some time. It's not going to be wished away. So fourthly, we think the markets had made an irrational top at 9,000 and they were ahead of the earnings cycle. It's a good opportunity to buy because we think the earnings cycle will definitely turn in 2017. But in the short run, we think 8,400 is a proverbial target which the Nifty can hit, given the fact that FIs have also turned cautious. To note that, I'll let you know that yesterday we did 11 lakh crore on the F&O market, which is the highest ever volume, and which tells you that protection buying has now crept in. So if markets are going to be varied, then definitely I think next week you could see 8,400 on the card. Today you could see a relief rally also on the back that today is 30th September and there is a lot of NAV propping, as you know. So I think that could be what could say today's rally in the back that global markets are correcting. But we still think there is a little bit more weakness to go on the Nifty, another 200 points according to us.
Right, but when it comes to fund flows, yes, there have been a lot of protection buying in the F&O space, but cash buying, the FIs were buying stocks in the cash markets worth more than 3,000 crore rupees. Does that suggest that they still remain positive on India for the longer term? The uptrend that we've seen since March onwards, is that still intact, or now all that is up in the air?
Well, you'll have to take that in two contexts. Yesterday was the listing of ICICI Pru, and a large part of the inflows which you sought were earmarked for that by a large amount of pension funds. Notwithstanding that, we still think that FIs are overall bullish and especially the long-term players. But in the short run, the volatility will hurt. So if you are looking for a rally back to 8,800, I think that is not on the cards. You would see more weakness creep in because globally you cannot be isolated. India has been on a correction wicket in the last fortnight, and we think that process of consolidation stroke correction can continue. Time-bound correction, consolidation, and Anisha is going to be the theme for the first half of October.
So if I, as an investor, bought stocks when the Nifty was closer to about 8,500, what should I do? Should I, let go, look for lower levels to buy again? Should I just stand on the sidelines? Should I look to buy more? What should I be doing?
Well, it depends firstly on your horizon. If you are a short-term player...
Save your long-term investors.
Yeah, long-term investors can't let this opportunity go by. Any weakness, stock-specific, would be an opportunity to buy. We've been extremely bullish on some of the mid-cap stocks, and we think there is still huge amount of upside on those stocks. So use all declines to buy, because 2017 beginning onwards, we think the real bull market with a new high in place will be in tandem, and the short-term volatility will be over. However, in the short term, you are aware that geopolitical risk does not subside in a day. It will play out its course. And globally, if we see a weakness creep in the banks, then foreign selling here will countermand that the rupee can get weaker and bond yields can rise. All these four negatives are there. If you are ready to withstand that, then it's a good time to buy immediately.
Right. Sanjiv, you're saying 2017 onwards is going to be a good time for the equities. But there is a widespread expectation that the US Fed is likely to move and, sooner than later another rate hike is coming through. The last rate hike that happened in December had a huge sell-off in the month of January and February. So how does this now tie in with your expectation that equities will be bullish January onwards when, a rate hike in the US can come anytime the next 3-4 months?
Well, Anisha, before that, there is another elephant in the room, and that is the US elections. And I think even the Fed has kept it tight because of that. That will be the real event, and whatever the outcome, definitely a rate cut is on the cards in December, and I think the markets are geared up for that.
A rate hike.
A rate hike, sorry. So the markets are geared up. What will be interesting to note is how the Fed language changes, and if whether in early 2017 there is another rate hike coming after that, because bond yields have definitely peaked out at 1.4. They've retraced all the way to 1.7, and I think the era of low bond yields in Europe and US may be over. So if money cost is going to rise, then that will have a tantamounting effect on other asset classes, particularly emerging markets. But I think that is far-fetched. We definitely think a December rate hike is on the card. Before that, we will have to see how the markets deal with the US elections, which will be the next major event the markets are going to discount.
All right, if there is any pulling back on the liquidity that we've seen, so obviously investors will have to be more selective. You know, everything is not going to run up, or the tide is not going to carry all the boats from here on. So what would you pick for the next bull run that you're saying is coming up? What sectors look good? What stocks look good?
Well, firstly, consumption as a theme. We've seen that play out in banks, autos, and a large part of the consumption market. And that is on the back that with lower inflation, rate cut on the anvil, and the seventh pay commission money exchanging hands, we think that could be the forefront in the next 4 months, also on the back of festival season. However, a large part of that is played out in the stocks, but we still think that consumption stocks should be bought aggressively. Just to name a few, United Spirits is one stock we've been extremely bullish. Even though the stock is up 7% today, we think 2750, 2800 by Diwali should be the key on that stock. Similarly, Tata Global, another stock which we are extremely bullish, where the Starbucks brand is playing out well on the and so on. So I think consumption as a theme. On top of that, you could have infra on partly basis, and some of the financial stocks, the NBFCs, which after a correction will again stand to gain on the back that PSU banks aren't expanding on the credit side, and that is passed on to the NBFCs.
So USL is something that you like. What are your other picks? Can you take us through them with the targets that you have?
Yeah, so USL is our topic on the consumption type, target of 2750 in the next 3 months. The other is Phoenix Lamp. We've been extremely bullish on Suprajit Engineering, and Phoenix Lamp is acquired by that company. Stock is at 160. We have a target of 175 first and 190 by the year end. And thirdly would be Wipro. This would be our dark horse on the IT front, given that the stock's price has bottomed out around this 470, 475. It is one of the more reasonable large cap IT stocks with maybe uncertainty on earnings for another quarter. But we think second half of 2017 can see at least a 30% upside on Wipro. That is one of our top large cap picks also.
That's very bullish for Wipro, which has been a rank underperformer for most of this year on disappointing earnings. What else would you like? What do you do with some of these names that have moved up quite a bit and they look expensive, especially cement and even some of the private sector banks? What do you do with them? Well,
also I'll, as a disclosure, say that Ultratech is another stocks under our coverage with a buy rating. We would use another of those days like yesterday at 3750, 3775 to accumulate Ultratech. We are extremely bullish on cement, and we think the pricing power and volume growth will be the trendsetter come the month of October, where you will see construction activity pick up. So cement definitely is going to be an outperforming sector on the macro side. Aside from that, banks, we would be little varied because we would wait for results, particularly the PSU banks, which have run up far in excess of valuation, and we still think the NPA process may not be that easy. State Bank would be a good pick, closer to 225, 230. Why are we giving those targets? Because we think, like yesterday, if there is a repeat again, these levels become the comfort of having price on your side.
Right. You said that you expect strong volume growth for the cement companies, but while the consumption boom is expected, the capex cycle is still not taking off. So where is that comfort coming for cement majors, or even other than the road companies in the infrastructure space? There's still in the power space not much happening. There's a lot of capacity in the spot markets. So what's your take on these sectors, industrials and infra?
Yeah, that's a good point. Capex on the private side has hardly picked up, and it's all government spending which is actually driving your GDP. But I think it's a matter of time. Confidence is returning. Definitely, government has taken a lot of proactive reforms, and it's just a matter of time. If steel prices from 21,000 are back to close to 30,000. Most of the ferrous, non-ferrous, both side metals have bottomed out, and we are going to see a large part of that in expansion. And there is going to be release of almost 3 lakh crore worth of pending litigation and environment issues on the real estate side, which can actually give you the extra kicker. On the other hand, cement pricing front, the companies have managed to keep them at an elevated level. And like you said, I think volume would be the next key which will drive the growth for cement players majorly.
What are the areas you're looking to avoid? Do you think that there may be some sectors that will take longer to perform? It'll, the earnings will still take some time to show. What are the safe avoids at this point, or the clear-cut avoids at this point of time?
Well, the clear-cut avoids have more or less bottomed out. Metals, PSU banks, which the price front on the stocks is they are discounting weak earnings and playing out. On the other hand, telecoms is one area which we would definitely avoid, because this pricing war is not going to leave is going to leave a sour taste. And on the other hand, some of the excess run up in some of the oil marketing companies, we would be a little cautious there, because if oil is on a pullback, then that will definitely hurt margin. So you have to be selective, like we said. We are more bullish on the mid-cap stocks, where we think the bang for the buck is going to be much more on the back that earnings will catch up, and in niche sectors we could see outperformance.
Right, but mid-caps, some investors are a little worried because you could burn your fingers as well. So is there any 1, 2, 3 checklist that you must look at before you buy something? What would you advise investors?
Yeah, so just to say a name, in the reality space, even though the sector is under stress, Godrej Properties been one of our top picks, and that is stood out on the back that pedigree, management and execution. So you would have to do the groundwork yourself and seeing how the management is, what is the visibility and what is the background. Mm-hmm. That is your routine check. But Anisha, if you are in a bull market at close to 30,000, the risk reward is favored towards you taking a bit of risk. Mm-hmm. So you will have to be doing a lot of diligence, and we still think in certain mid caps, which even today are mid caps, some of our recommendations, Cosmo Film, NBCC, EIL, pedigree names with the government of India behind couple of them, and the other being a big beneficiary of the GST. The business environment is looking extremely conducive for these stocks to report much better earnings and growth.
All right. How about the pharmaceutical space? For the last 1 year, many of these pharmaceutical stocks have been beaten down. Some of them have still perhaps not recovered as much. Say, Aurobindo has recovered, but the Sun hasn't done anything. Would you relook some of the names in the pharmaceutical space?
Well, that is a tough part, because we think this FDA scare is going to be there, and we know that a lot of the companies have been languishing on the back of that, on which the domestic investor has no control. Because it's all external, and I still think that a lot of the valuations are still stretched. Stocks like Lupin and Sun Pharma are not at the top of our list. In fact, we've had shorts on both those stocks since a long time as a disclosure. Our top pick was Dr. Reddy, closer to 28.50, 29, where we thought most of the bad news is in it. But our top pick over there continues to be Cipla. Okay. We think Cipla as a stock and the business quarterly earnings which they reported last has definitely bottomed out, and the stock now looks set in the next 1 year to be almost close to 650, 700. So Cipla and Dr. Reddy on declines would be two of our top picks in the pharma front.
All right, Sanjiv, thank you so much for speaking with us at NDTV Profit, telling us what is your view on where the markets are headed, as well as your top picks amongst stocks and sectors.